Hi everyone. In this video I'm going to go over the discounted cash flow model that we have in Stockcalc. The DCF model is the most powerful tool we have on the site. If the quality of the data going into it is good, it's a very powerful tool to analyze and come up with the intrinsic value for the companies that you're looking at. The reason I say if the quality of the data going into it is good because it depends on a few factors to come up with the discounted cash flow values. We require a forecast into the future, either generated through analyst data or growth forecasts, and we require the weighted average cost of capital. It also includes tax rates and projected long-term growth rates for the company. So in order to run the discounted cash flow, we actually need a forecast, and we can generate it through the analyst or growth forecast tools that we have. You can see the other videos for those. And the cost of capital, the weighted average cost of capital that we have for the company. So if you're running a discounted cash flow, it's advisable to spend some time with both the forecast and the cost of capital and go into some details there to understand what's involved, what you're generating for those. Because when we run the discounted cash flow, any company that you see that shows up on the drop-down list has a forecast and a cost of capital in it. So in this case I'm going to select ABB, which is one we ran here earlier. We have a forecast and we have a cost of capital for the company. The way the discounted cash flow works is we start with a cash flow projection. I'm actually going to make the screen a little wider here. We start with a cash flow projection. Generally we use the EBITDA to start. We can also use the free cash flow, but in this case what we're doing is normalizing and coming up with the free cash flow amounts. We apply the taxes to generate an after-tax cash flow. Then we look at the capital investment the company has to spend on a go-forward basis, and what we do is we use the last 5 years to generate a historic average capital investment required. Companies can be quite sensitive to this CapEx number. Calculate the tax shields from that, some incremental working capital again based on the last 5 years historic, which gives us a discretionary cash flow. Now I know I'm going into a lot of detail here, but to present it, really what we're doing is we're taking cash flows, so projections into the future, we're normalizing them, applying the tax rates, and looking at CapEx that needs to be spent on a continuing basis for the company. We do this for the first 3 years into the future, and then we apply a growth rate from years 4 and beyond. And what that does is that gives us sort of two pools of cash flow. The next 3 years that we have more confidence in, and then beyond that. In order to generate the cash flow beyond that, we actually come up with what we call a terminal multiple. You can see the formula there. So it's a factor that we apply against the discretionary cash flow from years 4 and beyond, so that we can come up with a capitalized terminal value. So you can see we've got a discounted, we then apply the discounting factors, the weighted average cost of capital against those cash flows. We come up with a present value of the discretionary cash flows in the first 3 years, and then the discounted terminal value. So you can see we're showing $6 billion in value in the next 3 years, $30 billion thereafter from years 4 and beyond, for a total of 36. We add or remove any redundant assets. We come up with an enterprise value. If there's debt, we remove the debt, divide by the number of shares outstanding, and that gives us a value per share calculation. So you can see in the initial pass that we did here, prices currently trading at $21.30, we're coming up with a $17 value for the company. So there's a few things we could look at. We could spend some time looking at the capital investment. We could actually go in and load the company into the snapshot, take a look at the historic values, see if they've been trending up or down, because as I said, we're just using the average here over the last 5 years. We can also take a look at the cost of capital calculation in more detail. And I'll just, for example, what if this was 9 instead of 10.51? That would take our valuation up to the current level, basically. So that's something that we would want to look at. We can also look at the sensitivity of this terminal growth rate projection. If we think the company is going to grow for the very long term at 3% versus 4%, you can see the impact that that's having. So again, a very powerful tool that once you build the models, you can actually do a lot of what-if analysis on the company to see what you think the valuation would be.